Hello, everyone, and welcome to this week's episode of Financial Planning Explained. I'm your host, Mike Menninger, certified financial planner, and also president and founder of Menninger and Associates Financial Planning. In last week's episode, we were talking about the real estate market and how the real estate market has been absolutely insane chaos and going in the right direction. Well, fact of the matter is that, if you're looking to buy a home, in all likelihood, that is going to be the largest investment that you will ever make in your life for most people. And generally speaking, unless you're filthy rich, you're going to find yourself having to get a mortgage, which leads ourselves perfectly into today's guest. Today, I am introducing Kevin Stegena, who is mortgage broker for
Lending Capital Mortgage.
Lending Capital Mortgage. Okay, see, I'm relatively new at this show, Kevin, so I messed this whole thing up. So you have absolutely nothing to worry about today. Kevin, thank you very much for joining. I appreciate it.
Thanks for having me.
We're piggybacking on last week's episode where we were talking about the real estate market. Well, guess what? If we're looking to buy a mortgage, that's where we have to come. So tell me a little bit about yourself and your company.
So we're a mortgage broker in Lower Bucks County.
Okay.
We service the whole Pennsylvania area, though, primarily in Bucks and Montgomery and Philadelphia counties.
Okay.
But like I said, we service the whole Pennsylvania area. We started about 2 years ago. I opened up my own mortgage company because I figured I could offer the customer my own personalized touch to the very unique and the way mortgages are so tough. I figured I could put my own spin on it.
Okay. Well, what makes mortgages tough?
So there's a lot that goes into a mortgage.
I'm sure there is.
Yeah,
and I know there is.
There is. It's not just, one product fits all. And unfortunately, that's the way a lot of banks think. So, you have to take the client's certain situation and their scenario and find the best product that best fits them, because there is a lot of mortgage products out there.
I'm sure there are. And, that's actually, whenever I refer people to a mortgage, to get a mortgage, I generally prefer the mortgage broker because it works, and like we referenced a lot of products, my understanding is that it works kind of like life insurance in that, a certain insurance carrier is going to insure this type of person. But I would imagine that the mortgages, if you have somebody who's in a lower credit rating, then they may have to go with this particular lender. But if they're in a high credit rating, they may go with this particular. Is that how it works?
That's correct.
About how many different lenders or banks or institutions do you represent?
Oh, there's hundreds out there.
Wow.
We work with probably about 20.
Okay.
20 different lenders.
I got to imagine that you can fit everyone. So, curiosity, how low of a credit score can someone go before they are basically denied?
So, before COVID, we were able to go down to about 580, sometimes in some cases 550, with a larger down payment.
Okay.
Now there are some overlays with COVID and some tighter restrictions because the banking want to be more secure. They don't want to be lending to people that are going to be losing their jobs because of COVID and stuff.
Of course.
So now, typically right now, until COVID, everything gets better with COVID and the pandemic ends, the minimum credit score is about 620 to 640 right now, depending on which program you go with.
So I've had it happen. Actually, when I bought my very first house, we had a situation where my spouse lost her job and it threw a bunch of wrinkles in the gears. Have you ever had a situation where you've had to redo a mortgage and pull one spouse off?
Yeah, absolutely. If one spouse has a lower credit score than the other, then we might just have to use the other one that has the better credit score.
But then you lose that lower credit income too.
Correct, but if the one borrower, the wife or the husband, makes enough money to support the mortgage, we can do that. And sometimes that's more favorable because if they have a credit score, let's say it's 720, and the partner has a credit score at 640, that's a much better interest rate you can get
with
just using the one borrower, and could result in saving a lot of money per month on the mortgage payment.
If you have a couple going in and one's a 720 and one's a 640, they basically assume 640, correct?
They go off of the lower of the two middle scores, correct?
So let's look at that for a moment. So as you indicated, the lower credit score, and I understand this, and I'm going to try to put it in a way for the viewers. The banks don't like to be owners of properties, okay? They don't like to see an owner of a property foreclose, because then all of a sudden they become the owner of the house. And so what they do is they command for people who have a lower credit score, they want more money down because if they're more likely to default. And so the other thing they do is they also do a higher interest rate for them, don't they?
Correct, yeah. If you have a lower credit score, you're going to have a higher interest rate, for sure.
Okay, that's interesting.
That helps secure them, you know.
So a lot of times, as I do financial planning for clients, I have them looking at either refinancing their mortgage and taking cash out, which is a conversation I know we had not too long ago. There's that, but then I also take a look at the debt to income ratio. And the debt to income is, for the viewers, they take the total amount of income that you make on a monthly basis, multiply it by a certain percentage, and that's how much you can afford. I've been using 40%. Am I wrong on that? What is the right number?
So that's actually a good number, because you don't want to put the borrower in a bad spot where they're house poor and their mortgage payment is more than what they can afford. However, typically, depending on different loan programs, conventional will allow you to go up to about 48 to 50%.
Oh, really, that much?
And FHA will allow you to go up to 57%. Total debt ratio. Housing ratio is a little different. Housing ratio is just the housing payment divided by your income. That can only be about 46%.
I didn't realize it was that high. Honestly, I think 57% is crazy.
It is. It's putting the borrower in. I mean, they do allow it, but I would say we never try to give a borrower a pre-qualification that's going to take their debt-to-income ratio up that high, because it's just not setting them up.
No, you're setting them up for failure.
Yeah, that's not good. They're going to be really tight on their, money every month. So.
Absolutely. No, that's a shame. So, given the low interest rate environment, given the high demand on real estate, I got to imagine that you've been busy lately.
Things are very busy.
Yeah, I figured
that. Very busy.
I figured that. So, and one of the things I recently did is I recently refinanced my mortgage, and I took it from a 30 to a 15, got a ridiculously low rate.
Yep.
Okay, and believe it or not, my payment didn't even go down that much, which was a nice thing. And so I imagine with today's interest rates, you are getting refis galore.
Yeah, refinances are definitely primarily the building up the pipeline mostly. We still do a lot of purchases.
Yeah.
But everybody wants to take advantage of the low interest rates right now, because people are saving on average $200 to $300 a month, I'd say, per my client base.
Absolutely, and I would imagine, I got another question. I know I'm sure you do cash out mortgages, but let's say, for instance, I have $200,000 left on my mortgage, and I have $30,000 of other debt, whether it's high interest rate, bad debt of whatever sort that I'd like to pay off. If I do a refi, if I did a straight refi of my mortgage of $200,000, that's one thing, but it's considered a cash out if I increase to pay other stuff off, correct?
That's correct.
Does that change the interest rate?
It does. There's a little bit of a rate adjustment. It's only about a quarter, but the amount that it can help save you on your monthly debt is exponential.
Oh my goodness, I know that. I know that.
We take clients all the time. That's how we kind of separate ourselves from others. We don't just refinance. We look at the whole big picture. We take all the liabilities. We try to wrap them into a cash out refinance. There's sometimes we can take car loans that are at 10, 20%, credit cards at 19.
20%, boy, their credit can't be that good if they're paying 20%.
Well, it all depends. They could have gotten that credit card years ago, and we're able to consolidate that debt.
Yeah,
sometimes
absolutely.
Save people $1,000 plus a month. If
Oh my goodness, absolutely. Oh, there's no doubt. Not to mention that, potentially tax deductible on the mortgage, but there's absolutely no tax deduction on the credit card. Credit card debt is just horrible because most people can never keep up and catch up. And, to the extent that we can get rid of credit card debt, believe me, we do the same thing with our clients. We really look at it. I mean, we send clients to folks like you all the time, because refinancing in today's rates, you just can't beat it.
Yeah, you can't beat it. It's something that everybody should be looking into. If they have a rate in the 4s, maybe even high 3s. They should be taking advantage of the lowest rates because we hit history several times in the last couple months. We keep hitting a new mark where they've been the lowest in history.
So let me ask you a question. What's it cost to refinance your home generally? I know historically, and I'm going to, for the viewers, and I have this discussion all the time, I refer to recoverable and non-recoverable costs. Recoverable costs are, if you have to pay off your escrow, well, you're getting the escrow back.
Sure.
Okay. And similarly, oftentimes I'm going to refinance and I'm not going to pay, let's say, my August bill, but now then my next payment is in September. Well, I got to pay that interest because I would have paid it anyway. I consider that recoverable costs. The non-recoverable costs are all those silly fees, one of which annoys me to no end, is the
title fees.
Titles fees, thank you very much. It drives me crazy because if I refinanced 2 years ago and refinanced again, nothing's happened to my title in the last 2 years. It's highway robbery, but it's established by the state, isn't it?
Correct. And again, to break down your cause a little further, the amount of cost that you roll into a refinance, you typically get back, I would say 70 to 80% of that if the file is structured properly, because you're going to skip the 2 months mortgage payments if you close towards the end of the month. You are going to roll in some prepaid interest, but you're going to skip the 2 months mortgage payments and you're going to get back an escrow refund check for whatever the current lender has sitting in an escrow account for you. And depending on what time of year that is, that could be several thousands of dollars to, maybe even $6,000, $7,000 if people have higher taxes.
Of course. In fact, aside from that, one of the things that I've looked at is, in a very simplistic manner, is you take a look at what the non-recoverable closing costs are, the title fees and all of the other little fees that go in there. And what I'll do is I'll take a look at that total cost, and let's just say for argument's sake is $4,000. If they're refinancing a $200,000 loan and getting 1% better, 1% of 200,000 is $2,000. They're getting that back in 2 years.
It's actually sometimes a lot sooner, Mike, because the amount of interest that you are paying in that 1% higher each month to the bank instead of to your principal balance is much higher. So if you add up the amount of interest you're saving every month in that payment, plus the amount of that you dropped in payment, it's, I would say if you dropped 1% on a $200,000 loan, you're probably saving $40,000 to $50,000 over the life of the loan.
Oh, easy. Hey, this has been great. Believe it or not, it's time for a break already. All right, so what we're gonna do is we'll come back. Thank you for joining us. We will be back in about a moment or two. Please enjoy your commercial break.
They are the greatest fighting force the world has ever seen. But what does it take to strengthen our service members? What does it take to let them know that we stand behind them, wherever they are? What does it take to bridge the distance and keep them connected to family, home, and country? And what does it take to prepare them for their future when their service to the nation is complete? What does it take to strengthen our service members so they can be the greatest force for good in the world? It takes a force. Be a force behind the forces. Share a message today at force.uso.org.
I want to be a contender. I want a warm belly to sleep on.
A big house.
How do I look? Do I look good?
I want to play hard.
My nails done once a month.
I want
a home.
I just want a home. I want someone to love.
Last year, more than 30,000 companion animals came to us without homes. 20,000 of them were felines. Let's make some homes together.
Add us on social media to watch bloopers, behind-the-scenes footage, previews, and more.
Welcome back to Financial Planning Explained. Host Mike Menninger, certified financial planner, and I'm here with Kevin Stegena. Thank you very much, mortgage broker. This has been terrific.
Thank you. Thanks for having me.
We're having a tremendous amount of stuff. I want to ask you some questions as to how it relates and what you've observed. I've heard that we're beginning to see lending that are going back to like some of the practices that they were doing in 2007. I'm not saying you're doing that by any stretch of the imagination, but you're in the industry. Are you seeing the industry beginning to give loans to people who shouldn't be getting them?
I wouldn't say that necessarily. However, you are correct in some aspect. There are a lot of non-QM banks coming back out.
Non-QM?
Yep.
What is that?
Non-qualified mortgage.
Okay, thank you.
And they are, that's something that Fannie Mae, Freddie Mac, FHA, USDA, they will not purchase. So that is just a private investor doing a loan for someone that maybe can't get approved with a regular government or Fannie and Freddie Mac loan. Some of those loans include, they'll do like bank statement loans, where they no credit score qualifying, no income. They'll just look at bank statements for the last 12 months, and you could get a loan. And
so that raises a question. So what happened in 2007 into 2008? What the banks were doing is they were doing all of these loans, these crappy loans,
yes,
and then they were packaging them up and selling them to Wall Street. Then Wall Street was then doing something and then packaging it up and packaging it up. And it finally, it's like musical chairs, it finally came to an end. I felt as though one of the solutions to the problem is if you lend me $200,000 for the mortgage, you're sitting on it and servicing it. So in that particular instance, if that bank is giving that lousy loan, or the one who is not very qualified, the non-QM, are they eating it? In other words, if that person goes and defaults, is that bank going to be the one responsible for it?
Yeah, I'm sure there's some type of insurance backup, but I really don't do a lot of non-QM loans.
Yeah.
I do government and Fannie and Freddie Mac, USDA.
Okay.
I do those kind of loans.
Lots of alphabet soup there. So
yeah,
I would like for you to, I'm very interested in understanding, because you hear about Fannie Mae, Freddie Mac, Sallie Mae, FHA, FDA, ABC, CFP, CPI, it's all alphabet soup. I'm joking and laughing with it. But fact of the matter is like, what is it? I mean, USDA, I think USDA is putting a stamp on my piece of beef that I'm ready to throw on the grill tonight. So what does the USDA have to do with mortgages?
USDA will write mortgages for consumers in rural areas.
Okay.
They will allow for 100% down payment, or 100% financing. So
Really?
Zero down payment.
Do you have to qualify for that? Like a certain qualification?
There are qualifications. So you can't make over a certain amount of money per household.
Okay.
And again, it has to be in a certain rural area. It can't be anywhere like in the city of Philadelphia.
Okay.
Telford, Solderton are major areas. Some parts of Doylestown.
Really? Doylestown?
Percy, yeah.
Well, I mean, there's some nice territory out there.
Sure.
But so what does the bank do, or the USDA do, to protect itself from the risk of foreclosure? Higher rates?
No, they have mortgage insurance just like the FHA.
Right, that's PMI.
Yep.
Right, okay, but how much is PMI? I think they changed. It's like 0.085% or something like that?
That's correct.
What is it, 0.085% of, if I have a $100,000 loan, that's $850 a year, which is about $70 a month. That's how it works?
That's about right.
Okay, yeah, well, you know what? And then my understanding is that once I reach a point where I have 20% down, I can apply for.
That's with a conventional loan. With an FHA, USDA, or government loan, that is not the case.
What is the case?
You're going to pay. No, upfront and MI every month, and you're going to pay for the life of the loan.
The life of the loan, no matter what.
So the goal is to get, if someone is, if at that time an FHA loan, USDA, VA loan fit. Well, VA loans aren't going to have mortgage insurance. They're great loans.
Okay.
All loans are great. But if you get put an FHA or USDA loan up front with a low down payment or no down payment with USDA, the goal is after 7 to 10 years, once you have 20% equity in your home,
Right.
is to refinance into a conventional loan.
Oh, you have
So
to refinance. Okay.
That's the goal, so that you do not have to pay mortgage insurance.
Yeah, but then when you refinance, then you have to pay all the closing costs and everything else, and you run the risk, especially today. If you're getting this ridiculously low rate, which, by the way, ridiculous is good. But if you're getting this really low rate today, and 7 years from now, I'm at 80% loan to value, which means I have 20% down. I don't want to refinance at 4% or 5%. That's backwards.
Yeah, that's unfortunately that's the market. If rates aren't favorable for you to refinance, then you just gotta wait.
Suck it up and eat the 8.85%, right? So that applies to USDA and FHA, all USDA and FHA loans?
Correct. They're all gonna have mortgage insurance.
All right, and so is FHA loan, is that the one where you have to put 3.5% down?
That's correct. That's
All
the
right.
minimum down payment. You can
Right,
put down
okay.
more, but that's the minimum you're allowed to put
Okay,
down.
so if I then wanted to go to conventional, okay, then that's where I have PMI only until 80%.
Correct. 80%
So,
LTV.
so why wouldn't I go to conventional instead of FHA?
Because, well, if a borrower is qualified, there actually are low down payment options for conventional, as low as 3%.
Really?
Yes. Again, there's income restrictions, but if a borrower fits a conventional program, and we can get them into that program with 3% down or even 5% down, then that is the program we will typically advise that they go after.
It sounds like it because, particularly with today's real estate market, if I bought a house with, say, 5% down a year ago, with today's real estate market jumping like it is, I may actually, without having to really have put much down into my mortgage,
That's correct.
I may reach the point. So now, how do you go about applying to the mortgage company to get out of PMI? I think of it like the doghouse at home. The doghouse is really easy to get into, but boy, is it tough to get out of.
Sure. You mean for the mortgage insurance? Correct?
Yeah, how do you get out of the mortgage insurance?
So at 78%, automatic cancellation. They'll do.
But somebody's got to prove to the mortgage company the value of your home.
Yes, but you could call if you believe that the value you have 20% equity once you're at 80% LTV. You can actually call and request them to do a check to see if they can get rid of mortgage insurance for you.
Right, except for one thing, it's not in their, it's, like, why would they be motivated? Because they're getting free money.
Exactly, yeah. You have to do your due diligence and pretty much follow up with them and check.
Okay, so what was the 78 you're referencing?
78% automatic cancellation. So if they do a value report in the back end and see that your home has 22% of equity, your MI will automatically cancel.
Well, that's if they do a value report in the background. Is that something that they routinely do?
I can't say that. I wouldn't know that, but I'm pretty sure that there are systems in place to keep checking that.
But once again, I don't see why the bank or the mortgage company would be motivated to do that, because then they're losing that.
I see your point for sure, but.
All right, so those bad guys, you gotta. So the story of it is that you really ought to make sure and you follow it, because there's a lot of people who have bought. So go ahead.
I can piggyback off that a little bit. One of the things that kind of stops that from your worry of are they really checking into this is most people refinance within 7 years, 5 to 7 years. That's actually statistically proven. So I think within 5 to 7 years, people are either going to put down enough money to get to that 20% mark, or the value has gone up enough to where when you do the refinance, you do an appraisal.
Right.
Automatically, it's figured out that you don't have to pay MI anymore.
Well, you know why statistically it's been 7 years? Because we've been on a almost 40-year declining interest rates.
Yep.
So the reason why it's every 7 years is because the big run was also in 2012, because we hit a dip in interest rates when everybody's looking back, it's like, holy cow, I can refinance and get this 4%. Could you imagine getting 4%? Wow, that beats my 6 or 7, right? So everybody's refinancing like crazy. Interest rates kind of came back up a little bit again, and lo and behold, About 7 years later, here we are again. 7 years later, the interest rates are ridiculously low again. So what other programs are there out there? I've heard of first-time home buyers. Is there anything for veterans, college graduates? Are there any type of other programs out there?
Yeah, there are assistance programs for first-time home buyers, like a down payment assistance. First-time home buyers is FHA. There's a 3.5% down. They also have programs that will help assist with that 3.5% down.
Really?
Yeah, and then they have some of our lenders have special programs for our men in blue. So they get down payment assistance, police officers, medical workers,
nice
stuff like that. There's a ton of stuff out there to help buyers get into homes.
So the thing is then the first-time home buyer only works with FHA. And just as we discussed a little bit ago, it doesn't sound like the FHA is the best program. Why would I, again, I look at it, and I'm looking at it, I suppose, from the PMI perspective, that FHA stinks, but conventional is good. Why would somebody go FHA? Is it because they lower the standards for income and credit score?
I'll give you a perfect example. Yes, that is correct. And also, some people don't have 5% or 10% down payment for a conventional. They can go down to 3% on conventional, but there's an income restriction. So usually if there's two borrowers, typically we're seeing in our area that their income is too high for the 3% down conventional program. So that gives them really one or two other options to go USDA, but they have to be in that area that's eligible.
Or we can stamp them on beef.
Or an FHA, or an FHA loan. But like I said, FHA loans are great for first-time home buyers.
Right.
There's a ton of first-time home buyer programs. So
as long as their income doesn't get above a certain level. If their income's above a certain level, then they can't go FHA, right?
Well, that's conventional.
Okay.
They have a conventional 3% down first-time home buyer program.
Oh, okay.
That's amazing. Low mortgage insurance, rates are really low, and 3% down payment option. But there's an income restriction. You can't make over a certain amount they have different counties have different limits. But in our area, I think it's about 76,000 or right in that range.
Okay.
So typically we're seeing two borrowers, wife and husband or a couple, they're usually over that amount, and that has to push them either to a 5% down or an FHA 3.5% down. And the other thing that pushes people to FHA instead of conventional is first-time homebuyers usually don't have a large down payment to put down, right?
Right, exactly.
So they have to pay closing costs and their 3.5% down payment, and FHA allows you to get up to 6% seller's assist from the seller. Conventional only allows 3%.
Right.
So if you can get 6% assist from a nice seller who's feeling, they want to help out, then you could typically get into your loan with only putting down the 3.5%.
Wow, that's amazing. So that's why we refer people to people like you, because you know all these ins and outs and the FHA and the 3%, 6%, the conventional and good, bad, and everything else like that. I mean, this is all really good stuff. Thank you very much. I'd like you to take a minute and look into the camera over there. Tell people how they can get a hold of you.
Yeah, I'm Kevin Stegena from Lending Capital Mortgage. We're in Lower Bucks County, Newtown, PA. You can get a hold of me on my website, lendingcapitalmortgage.com. My phone number is 215-776-8980, or my email is my last name, Stegena, STEGENA, @outlook.com. Or you can visit us at 12 Penns Trail in Newtown, PA. Thanks for having me.
All right, Kevin, thank you very much. Absolutely a pleasure. I appreciate it. I learned a lot. I hope the viewers learned a lot. So here we are. Last week we were talking about the realtor, but now we're really talking about the mortgages. The mortgages represent the single largest purchase that most people will buy during the course of their lifetime. We are at an absolute low in interest rates, which, as we talked about last week, this is what's raising the price of real estate. But the fact of the matter is that I am a firm believer that you bring in somebody who knows what they're talking about and can drive you to the right place. Way important to understand how the mortgages work, what you can afford, board, the interest rates, how the PMI works, which, can you get out of it after you reach 20% down on the house? Do you not get out of it? And all kinds of different ins and outs. Certainly as financial planners, we're able to guide our clients, but when it comes down to the nuts and bolts, that's where it really comes down to. You need to have someone from the mortgage side who really understands what the whole process is and has the ability to be able to guide you through what I refer to as the gauntlet. So again, I'm here to be able to provide you, the viewer, as much possible information as we can provide. And as your host of Financial Planning Explained, Mike Menninger, Certified Financial Planner, I look forward to seeing you next week. Thank you for viewing. Yeah.